Dipo, thanks so much for joining us.
Yeah,
I'm sure every time anyone hears about the government going to borrow a lot more, there are those concerns about, the debt sustainability and so forth. But I think what makes this obviously more interesting is that it's a Eurobond. So they're tapping the Eurobond markets again. We've seen Nigeria continue to go to that market over the years. What do you make of the move towards a Eurobond as opposed to perhaps looking for multilateral debt?
Yeah, I think one of the reasons why they actually move around that line is that it's easier to get that funds in the Eurobond market. Because when you start looking at other like IMF and all those, there's some conditionalities that you have to meet for you to be able to get such funds. So, and I think that's one of the reasons why they are actually moving to more of Eurobonds rather than looking for those multilateral
And
finance.
if we look at the pricing, because what I'm hearing is that, for the longer tenured bonds, it's closer to 7%. And I do understand that there was a rating downgrade to some extent in December. I mean, there was a note by Moody's suggesting that the outlook is different. So obviously that will be playing in the minds of investors. So do you think this is a good time to tap the Eurobond market, all things considered?
I think currently Ghana just did one recently. They did about $3 billion. And I think the fact that the global economy is still very much accommodative as we speak currently, it might actually be the best time for you to actually quickly tap into the market before you start seeing the market turning around. So I think that's one of the reasons why they are trying to leverage the window, the current window. And we have seen the strategy work for them in January auction when the DMO actually unprecedentedly actually issued far more than what was actually on the issuance. So.
But that, of course, that was for local currency debt.
Yeah, that's what I'm saying. So they are trying to actually quickly maximize the current low rates before the global economy will actually change. We've seen a lot of things at the beginning, towards the end of last year. Everyone is thinking that, okay, oil price is going to be at least trade around 65, 70 level for this year. But with the coronavirus, we've seen that the market expectation has changed. So you don't know what will happen in the next quarter or the H2 of the year. So they are trying to leverage the available opportunity now before the global economy actually turns.
All right. So how does all this, in your view, impact how investors perceive Nigeria's risk? So if we focus on the local debt markets, which we know the foreign investors are also tapping into, of course, at much higher yields, do you get the sense that there are any concerns about debt sustainability now that Nigeria is looking to tap the Eurobond market again?
I think what the investors are actually clamoring about is more of the capacity to actually, your revenue to your debts, cost of debt. Our debt to GDP is still one of the lowest in the African zone globally. And if you now compare that to, maybe compared to our peers, we are not doing badly when you say, okay, debt to GDP ratio. But when you look at our revenue to cost of debt, that is what is alarming. Because our revenue to cost of debt is like 60. You are funding, like about 55% of your revenue is meant to actually fund debt. It's alarming. So, and I think that is the real concern to investors. So they are the view that, okay, that's why I think they are more in the view to support the government to actually generate more revenue, look for ways to generate revenue rather than borrowing, which also makes a lot of sense.
In your interaction with those investors, do you get the sense that they are getting concerned about that dynamic in terms of the government's ability to generate revenues to pay off this debt?
Of course, they're actually concerned. They have, and that's what.
But it's not showing in the pricing, right? They are happy with the pricing.
Yeah, that's
they're asking for more yields now.
Yeah, I just said something that one of the things we are actually leveraging on is the fact that the global economy is actually accommodative. If you don't bring your money into Nigeria or maybe emerging market or some frontier market, where do you take the money to? Yeah. The yield in some of those environments are actually very, very, very low. So you look at the risks, the prevailing risks in those emerging market and frontier markets, and you want to compare it to what you have there, and you feel that, okay, the risk premium that you are enjoying over it is better, at least. It will give you a better return compared to when you actually want to compare it to what you get in those in the developed market. So that is the opportunity that Nigeria is currently enjoying. And that's the reason why I said that this is the best time for us to take advantage of that, because if the global economy changes now, the next thing is that you see a lot of capital flights. A lot of people will be leaving your economy. At that point, for you to raise funds at that time, it might actually be very, very difficult. And recently, the FMDQ and CBN, collaboration with the FMDQ and CBN, also elongate the futures market, the NDF market, to a 60 months, which more like a 5 years. So it's a way to also attract foreign guys to come to the market. So it's a way to tell you that, okay, you can come in and lock yourself into a 5 years instrument and same time edge yourself immediately. But the concern is that it is non-deliverable. So at that point, when it happens, what the CBN will just do to you is that they will subsidize your naira, but where do you get the FX? That might actually be a concern to them, but at least to some extent, they've been able to minimize their risk.
Interesting insight into the dynamics. Thank you so much for speaking to us today. Dipo Ajayi, Head of Fixed Income and Forex at Chapel Hill Denham.